Well, ladies and gentlemen, on the podcast today, we have Mr. Eddie Speed. A fascinating approach to things. It's even got me thinking about some of the rental properties that I have and just going out there and offering seller financing and then carrying a note. This is note investing. We make sure that we have the link to everything that Eddie goes through down below on his YouTube page, because it is, more you think about it, it just makes total sense with the way that you want to be the bank versus the landlord. And this is an approach to get there. Thanks so much. Welcome to Rethink Real Estate. My name is Ben Brady, and this is a real estate podcast aimed to deliver sales strategies, marketing tips, and business insights from industry experts and myself to build a listing-focused business for the future. Let's get into it. Eddie, welcome to Rethink Real Estate.
I'm so glad to be here. Thank you.
Well, when we had an opportunity to have a conversation and have you on the episode, is that I have to be honest, I'm surprised I hadn't tripped over something that you'd been explaining. I went over to your YouTube page and had a bit of a look through, but give us an understanding of what you're showing investors, how you're showing investors to be the bank versus be the landlord, because I'm really curious about this whole note side of the business.
Well, first of all, Ben, every market has its cycle. Right. And so I've been doing this for 45 years and I've seen various cycles in the business, but this is a very good cycle that we're in right now to essentially show people how to own a first mortgage on somebody's property. Let's just take the most basic thing that everybody in your audience will instantly know. Right. So in 2018, not in every market, so California markets or more expensive markets, this may not have been necessarily exactly true then, but they'll get the concept, right? Most people in 2018, if you paid cash for a rent house, you could make about 8% a year. Remember that?
Yep.
They call it a capitalization rate, right? Now you take the identical house and you make 4%. Same house, you just make a 4% interest on your investment per year, and you used to make 8%.
Right.
But wait a minute. If I go borrow money on the same house and I get a DSCR loan, right, or some kind of landlord loan,
Yep,
they're going to charge me 7.5%. Who's making more money?
the bank.
So I show people how to earn essentially between 9 and 12% interest without using leverage. Way better with leverage. And there's a way that I can show people how to do that. But just comparing cash to cash, I show people how to do it. So some people come to us because they have a rent house problem and they want to convert their rent house to seller financing.
Okay.
Some people come to us and say, I don't want a rent house. I had one or never wanted one because people complained about it. Just show me how to own a first mortgage on somebody's house. So some people, I show them how to buy a note. Some people, I show them how to create a note.
Right. I guess that I suppose that if I'm thinking about this from an audience perspective, and let's say that I'm looking at this, the thing that you miss out on, which again, by the way, I want to circle back on this as soon as I say it, is that you miss out on the capital growth of that asset. Is that correct?
You get paid for it now.
Right.
You don't miss out on it. You just get paid today versus tomorrow.
And I think that there's a part of that is there's a misunderstanding when it comes to the real estate values of things. Don't get me wrong. If you were to take any real marketplace that happened from 2020 to now, considering that even if they've come back a little bit, you're probably in the plus. But for a very long period of time, the real estate marketplaces for most of America, maybe not some of the fringe communities prior to COVID, there wasn't really any capital growth in it anyway, because, I look at this all the time in the perspective of buying properties in particular marketplaces that you don't specifically do it for the capital growth. You do it for simply putting your money to work in a safe asset for a period of time. But you're dealing with toilets, you're dealing with a roof, you're dealing with all the problems that come with that.
Well, anybody can take 2020 to 23 and call themselves a real estate genius. Okay?
Yeah.
But I've been doing this for 45 years, and I would call that a fluke. Yeah. I'm glad we had it. Don't get me wrong. I'm just saying to you, that's not normal or customary or sustainable. Right? And but what we do know now is because of expenses, what happened to the profitability of rentals was that expenses went up 2.5 times greater than the rents went up.
Okay.
Right. That is the core of the problem.
Right.
But the bottom line is, which business, Ben, have you seen that's perfect for 15 straight years and nothing changes?
The mortgage industry, really.
No, the mortgage industries are like this. I mean, it's terrible,
Right.
right? The mortgage production is off 70%,
Right.
right? But what I'm saying to you is no business, even the note business, even what I teach, is for 15 straight years the exact same thing,
Got it.
right? So what we really are seeing is a market timing situation, right? I don't want to stand up in front of your audience, and I train a lot of realtors, very, very, very successful realtors, right? And so, listen, I've got tons of realtors that make $1 million a year brokering real estate. And then they come to Note School and say, I want to take my investable capital and just learn how to own a first mortgage on somebody's house.
Right.
Right. So some realtors come to me because that they want retirement and a wealth strategy, and we're a pretty good way to do that.
Mm-hmm.
But other realtors come to me and say, hey, how could I get more listings? We're like, you get more listings because you could go show a landlord a little card trick that they would never think of, and no other realtor in your town would know how to teach them how to do it.
Right.
And that is, you take your rental and owner finance it and end up making 2.5 times the income today. 2.5 times the income you can on your rental, net income to net income.
Right.
Who wouldn't want to lean up for that?
Well, I think that's the more that you think about it, the more it makes sense, in the sense that it is one of those parts of this that if you don't really have to manage it in any way, shape, or form. But that's kind of where I come into this, in the sense that the way that you're doing this. So let's say that you've got investable capital, right? Let's not say that you're an owner of a couple of rental properties, because the seller financing side of it does make a great deal of sense, is that you would promote the seller financing side of things. You would then carry the note, so on and so forth. That's pretty straightforward, I think.
Right.
But then let's say you've got investable capital right now of $1 million. How do you find these opportunities, so to speak? Where do you tell them to start, Eddie?
All right. So I'm gonna start to one asset. Okay. So I'm gonna take just $1 million. I'm gonna break it down even smaller. You got a pencil?
Yep.
All right. You got $250,000 investable capital.
Yep.
You're gonna buy a rent house. You're gonna rent it for $1,800 a month, and 50% of the rent you collect is gonna go out in expenses, taxes, insurance, maintenance, all that stuff. Right.
Right.
How much are you then going to net? You're going to net $900.
$900. Yep.
Take $250,000 in investable capital, and that will average buying you $2,700 a month in payments. That's 3x. Oh, by the way, let's compare the stress.
Yeah.
You can own 55 rentals or 1,000 notes for the same level of work.
Right.
Okay.
But is it like, for example, if we bought OpenAI or all of these things, you have the opportunity to buy them at a particular time, you're definitely going to make money. Where does somebody go? Because people, I think, go to the marketplace to buy a property because they know how to do so.
So I've bought 50,000 seller finance notes. Okay. So I'm pretty good at knowing how to find them and knowing how to filter the good ones. And that is part of the school I teach. Okay. How to find them, how to do it efficiently, how to do it in a marketplace situation so you don't have to go stand up a brand new business. Mm-hmm. Those are all things that we've become very good at. That's the people. Once people get past the idea of I would rather today own a note than a rental property, which most people can conclude. Then the next thing is, okay, how do I do it? And how do I get my money back? And how can, or is there a leveraging strategy? And so let me just tell you something. I teach people how to use leveraging strategies to buy notes and to get their money back, a lot of their cash they've invested in notes so they can go buy another note. You know, I bought 50,000 notes. Think about it like this, Ben. Do you think I bought those 50,000 notes with the cash in my wallet?
No.
I had to use some techniques in order to use leveraging to make it work. And so those are things that are common to me that we've discovered are not common to a lot of people, and they want me to show them how to do it. And that's why I built a school 25 years ago.
Tell us more about the school. Let's talk about, and we'll make sure that everything is linked below, and people can obviously get access to it. Give us an understanding of what are some of the things that is taught at the school.
Well, once again, depending on the market, we've taught different things, right? So you can imagine after 2008, we taught people how to buy a lot of non-performing notes,
Sure.
right? And we still teach those strategies, but the thing right now is there's this insurgence of people learning how to make more money out of their rentals by seller financing it,
Yep.
or how to buy safe notes. Now, I didn't say just buy notes. I said buy safe notes, which are the ones that you should buy and which are the ones you should pass on. And so we've essentially built out a blueprint, a risk blueprint,
right, that
becomes not hard to follow. It's really, honestly, when you see how we lay it out, we just make it common sense.
Right.
It's not some weird formula or something.
No, I'm sure that it would come to common sense if you were looking to qualify somebody in some shape or form of whether or not it was a safe note or not.
That's it. And so the one thing I've learned about teaching people to buy notes is when they start, they get the concept to some degree, right? And the more that you teach them, the deeper they get the concept. But what they generally lack to start is confidence. And I've learned that knowledge takes confidence to competence, and then you can buy. And that's essentially what I've seen over and over and over.
Right. And I think
by the way, I've had great luck with realtors.
Yeah. Well, again, I think that they're in touch with the opportunity at all times. And I just think that it might be a part of the brain. And again, I'm talking for myself here, that really wasn't turned on until I actually sort of started to look, because I try to vet the guests as much as I possibly can and make sure that it's relevant to the audience. And to be honest, it's one of those things that, I either sit here, and I was thinking about it before, is that we've got several properties, several doors that we have and own. And I literally probably am going to get off here and go to my business partner and go, let's get rid of these things and offer people to own them, seller financing, and do a note instead. It just comes down to, we have a property management company, okay? And we manage quite a large portfolio for owners. And it is a utter shit show, for lack of better terminology. Yeah. Like, my property managers are not property managers. They are just maintenance request people. It's unbelievable. And then to deal with the misconception of what a landlord's rights are versus what a tenant's rights are in LA County, is where a lot of our rentals are, is unbelievable. It's not even worth the hassle or the trouble.
Well, once again, it's market timing. Things have changed, our society's changed, how we view things, and all that has become very different. And, I think generally, if I went into any audience in the country, and I've done this, call it more than 1,000 times, right? Mm-hmm. And I just ask the most basic of questions. If all things were equal, would you rather be the landlord or the bank? Guess what? In a room full of landlords, over and over and over, guess what they answer? They want to be a bank.
I'm hoping they say bank. Yeah.
Yeah. So we get the idea that a bank has a cushion factor. Now think about, let's go back to something I said a little bit ago, right? We did a comparison of investing $250,000, one in a rent house, one in a first mortgage. Okay. Well, the other thing about the first mortgage is you have a cushion factor you don't have with rentals. You see, if I buy a first mortgage for $250,000, my collateral is worth more than what I paid for the loan.
Yep.
It's worth $300,000. It's worth $350,000. So there's even a cushion factor, God forbid, and I believe there's an 8 times greater chance of a default on a rental than there is on a note. And we sort of underwrite to about a 3 to 5% default rate.
Right.
Like nobody can underwrite to a 0% default rate. But
No.
we've been doing this for decades, and we're pretty good at it. And we've learned this underwriting standard that we write to is going to ultimately be about a 3 to 5% default rate. We don't want anybody to have trouble. We just want them to be able to pay for their house.
Yeah.
But if they can't, a cushion factor does matter.
So I guess that from your experience, a buyer comes in, let's say that I have a property, and it's one of my rentals at the moment. I put it on the marketplace and I announced to my realtors that, hey, I'm looking for somebody to do seller financing, okay, because I want to carry the note, but they can obviously hold the asset.
Yep.
I guess that it's a different type of buyer that comes to that, because would a buyer, in your experience, prefer conventional financing because it's at a lower rate, or would they?
100%.
Yeah.
But who is conventional financing left behind?
I'm going to say most people, and the reason I say that is I've got a friend of mine that just purchased a property. This is one of the most well-qualified people that I know, like several millions of dollars of cash in the bank account, and didn't want to obviously use his own cash in order to purchase a property. And the experience that he went through with his wife, who, by the way, these two individuals make more than $2 million a year, and they were buying $1.5 million home. They've got more than that in the bank, was just atrocious. Like, it just was an absolute nightmare to go through from a conventional standpoint.
Listen, I have an interest in 9 businesses. And when the refi boom came along, we owed about 25% of what our house was worth. We, like your friend, had more cash in the bank times 4 than we were trying to borrow. We're in 9 businesses, and they tried to put me through a traditional Fannie Mae loan. Oh no,
Yeah.
no.
Yeah, exactly.
You're out. And so my wife and I both have an 800 plus credit score. Like we're not a big risk, but so we're a home for penalty box buyers, right? Not people that have historically bad problems about not bad credit. We can prove that we make the income, like not that, but like, let me just give you one quick little scale. Mortgage Bankers generates a graph called the Mortgage Credit Availability Index. Anybody can Google this. The day before the virus started, in January of 2020, it was at 185. Today it's at 95.
Wow.
You think anybody's been left behind?
Yeah, there's a few. There's a few indeed. I guess final thing as we sort of wrap this up, because again, general concept of this is that we want people to sort of explore this further, and we'll make sure that all of the information is below. But where do you see the market going? Because at the end of the day, you did mention cycles and seasons. And what cycle and season do you see for this period of time? Do you see it as just a blip, or do you see this as something where we're going to be in a cycle of oversupply and lack of buyers for an extended period of time?
Well, I think the residential mortgage industry, residential business has a threat. You've got listings year over year that we all know is a problem.
Yep.
You've got a home builder with an inventory that they haven't had since 2009. And you've got 1 million plus mortgages that are more than 120 days delinquent that haven't been dealt with. Average days delinquency on that 1 million loans is more than 800 days.
Right.
So you've got an issue in the market. I don't think it's 2008. I'm not trying to call that ball or that bomb. But for those reasons, we're going to continue to see rigid underwriting and rigid conditions. And so anytime that's the case, it always opens up the opportunity for in a proper way, creative financing.
Indeed.
And as long as there's creative financing, that market needs liquidity, and that means that we can buy notes.
That's right. It's kind of this market. You've got the conventional, you've got the hard money market. It's that in between that we see that opportunity in at the moment. And I've mentioned it on the podcast before, is that there was this, we did have a gentleman on who was in the creative financing space where he took people like yourself with 9 businesses. I was exposed to him through a mortgage of my own because we have 12 companies as well. And obviously some of those you run at a loss because of individual reasons. And these people will look through those and actually look at the underlying effectiveness of the person and what they have from an asset perspective and make calls. Yes, you pay a tiny bit of a premium, but it's actually not that much more than what the conventional element of it is. So I see this as a really great space to have some awareness. I see this as a great resource for the realtors and for the community that listen in on Rethink Real Estate. Eddie, any closing comments or anything along those lines?
Well, I think the next step, and this has been just a great interview, by the way, is that people then, we wanted to kind of get them to the whiteboard. We want to show them some real transactions. We've mentioned several things that, it's hard to explain clearly until we get to kind of the whiteboard. And so we've got a little what I would call an opportunity session where we look at real deals and real scenarios and show people things that we've talked about today in a way that it just becomes real to them. And that way it's a quick way to go figure out whether, hey, I like this and I want to learn more, or no, I don't want to do this. So we love the audience. We've had great luck with real estate investors, with realtors. And as you said, people that just want to earn more money and less aggravation.
Yeah, indeed. Well, again, thank you for your insights. Thank you for your time, and looking forward to seeing what this cycle brings, so to speak.
Check us out. We got the link on your page, and I think it'll be a little time well invested.
Thanks, Eddie.
You bet.
So about 75% of our audience hasn't liked, followed, or subscribed to our podcast. It would mean the world to us, and it would help this podcast more than you know to expand our reach if you were to like, follow, or subscribe on any of the platforms that you're watching or listening on. Thanks again.